Hello, everybody. Today we're going to be talking Bitcoin Torque. Now, Torque is the 100%, absolutely hands down word of the year ever since Michael Saylor disclosed in the last strategy earnings call what Bitcoin Torque is. And I got some feedback from you guys that some of this content is just too high level. You know, people really don't know what I'm talking about. So we're going to be defining Bitcoin Torque, why it's so important that you know this when we're making our Bitcoin treasury company investments this year. Bitcoin Torque is the most important financial ratio that you've never been taught in your business school because it undermines everything your MBA believes in. This single metric is a diagnostic tool for the Bitcoin age. It measures how much real hard money exposure a company extracted from every dollar it deployed into a Bitcoin strategy. The formula is elegant. It is the current USD value of a Bitcoin stack divided by the total dollars deployed to build it. That's it. One number, but within that number is an entire story of capital discipline, asymmetric risk, and executive competence, or in some cases, lack thereof. A Bitcoin Torque of 1.0 means that every dollar spent is now worth $1 in Bitcoin. Above 1, management turned treasury dollars into leveraged hard money exposure. And below 1.0, they lit shareholder capital on fire in exchange for a balance sheet tattoo. Why do we call it torque? Because in mechanical terms, torque is the rotational force that turns static power into movement. In financial terms, Bitcoin torque is what converts fiat inertia into Bitcoin acceleration. If Bitcoin is the new monetary gravity, then companies are now engineering spacecraft. And Bitcoin Torque tells you whether you're dealing with SpaceX or the Challenger. Now let's talk about why this metric matters more than your traditional finance playbook would like to admit. Bitcoin Torque is not just a cute crypto KPI, it is the capital efficiency litmus test for any Bitcoin treasury strategy. It bypasses the narratives and cuts straight to the question, did the board create Bitcoin denominated wealth, or did they just dilute shareholders for no good reason? Number 2, built-in leverage without risk. All right, high torque equities acts like perpetual call options on Bitcoin. When Bitcoin rips, these stocks scream higher. When it dumps, they crash harder than a tech stock at a bondholder convention. Investors need to understand this. Bitcoin Torque amplifies outcomes. It's a volatility multiplier embedded in the capital stack. Number 3, funding mix neutrality. Torque doesn't care whether your Bitcoin came from debt, equity, retained earnings, or some blend of convertible voodoo. That's the beauty. It's capital agnostic. You can compare Tesla's leftover Bitcoin to Strategy's bond-financed megastack on a single scale, which is pretty powerful. Wall Street doesn't value these companies despite their torque. It values them because of it. Projected Bitcoin Torque is now embedded in equity research models. A way to understand this is that this is the silent engine behind the multiple to NAV premiums. It's also an early warning sign for a strategic decay. So when Bitcoin rises but your torque falls, you know something's amiss. Maybe it's dilution, maybe it's ill-timed buys, maybe it's a coupon-heavy debt stack eating into upside. Either way, a falling torque is the canary in the capital efficiency coal mine. Now, if you're thinking this sounds like another crypto vanity metric, let me stop you right there, because it's not just legit, it's unreasonably elegant. It slices through every single form of capital structure gymnastics and gives you one honest number. Let me show you what it eats for breakfast. Debt versus equity, irrelevant. Bitcoin Torque doesn't discriminate between cash flow buys and convertible debt. It looks at what matters, how many real dollars were sacrificed to summon the Bitcoin stack into existence. If you self-mine Bitcoin, Torque doesn't give you a participation trophy. It includes the cost of the machines, the electricity, and the whole sweaty process of burning fiat to mint digital gold. This is proof of fiscal competence, essentially. ATMs and buybacks are rolled into the denominator. If your company raised cash with an ATM facility and used it to buy Bitcoin, Torque tracks it. If you issued shares and then bought those shares back to just look cool on Twitter, Torque is immune to your social media strategy. This metric allows you to convert apples to intercontinental ballistic missiles. That's the brilliance. You can put Strategy's hyper-levered bond stack next to Tesla's cash flow residuals, next to Block's early cycle sniper buys, and you get a standardized signal from all of them. One scale, one scoreboard, no excuses. Think of Bitcoin Torque as the international accounting standard of the Bitcoin epoch. If it's not on your treasury dashboard, well, you're kind of flying blind through the monetary storm. Now let's lift the hood on the hard money corporate war machines. This is the live Torque grid as of May 13th, 2025. Bitcoin at roughly $105,000. We got 5 Bitcoin treasuries on the list here. Now this is what it tells us. Block actually wears the crown. Jack Dorsey dropped a lean 261 million and walked away with nearly 900 million in Bitcoin exposure. That's 3.4x Torque. Tesla is the most accidental genius on the table. After its 2022 sell-off, what's left of the stack now sits at a pretty low cost basis, and the end result is a 3.1 Torque, which is a masterpiece of post-mistake positioning. And as you can see, strategy is the juggernaut. Good old strategy right there. The Torque of 1.54 might not sound flashy, but when you realize it's on over 500,000 coins, it sounds pretty nice. That's a 21 billion Bitcoin amplifier strapped to a rocket ship built from convertible debt and ATM. Metaplanet's already break even. Barely a year into its bond finance spree, it's cracked 1.17. That's a rare air for a company whose market cap used to resemble a GoFundMe page. Galaxy Digital is barely above water. They mined it, they bought high, and they spent like a drunk minor league hockey team. The end result's 1.07. They survived, but they did not thrive. In short, this table is a real-time diagnostic of who's executing and who's explaining. And make no mistake, Wall Street is watching. They don't need a press release to know who's winning. They just read the Torque. We're going to talk about Torque and the other Bitcoin KPIs and why Bitcoin Torque is the KPI that actually thinks like capital. Let's compare Bitcoin Torque to the other KPIs floating around here. They all have their use, but none of them think like capital. Bitcoin yield measures the percent change in Bitcoin per share. Bitcoin multiple is the Bitcoin net asset value divided by the Bitcoin dollar equity issued, which doesn't include your debt or your mining costs. Torque folds everything in. And then there's the NAV premium, so the market cap divided by the Bitcoin net asset value. And this is backward looking. Torque is the driver, not an echo of what's happened. Let's break this down. Bitcoin yield is cute, but it's incomplete. Hey, we increased Bitcoin per share by 5%. Yeah, that sounds great until you realize that they printed 15% more shares to do it. Bitcoin multiple flatters equity issuers and punishes innovators. It only counts equity. So if you use debt or if you mine coins, Bitcoin multiple says, oh, that's not my problem. NAV premium is the rearview mirror. You know, a lot of people don't think of it this way, but it's true. The NAV premium is telling you what the market is willing to pay after the execution of the strategy. It reflects the sentiment, but Torque generates that sentiment. It's the engine, not the exhaust. In summary, Bitcoin yield tells you what happened. NAV premium tells you what people think about what happened, and Bitcoin Torque tells you whether any of it was worth it. This is why Torque is becoming the go-to financial metric, not just for Bitcoin investors, but for boards, analysts, CFOs, anyone who's just tired of the performance theater and wants the hard money truth. Now let's enter the uncomfortable truth zone. Bitcoin Torque isn't just a scoreboard, it's a strategic map. And if you don't know how to read it, you're going to drive your capital off of a cliff. Here's what the smart operators already know, that high torque does not always equal better. In a bull market, high torque is like riding a rocket fueled by nitroglycerin. But when Bitcoin corrects, high torque companies bleed faster than anybody else. Tesla and Block, they'll feel a 30% Bitcoin drawdown like it's a margin call from God. Strategy has the lower torque, so with a stack so massive, it still shrugs off the volatility. Dilution can be accretive, yes, you heard that right, and that's kind of the strategy. If a company issues new shares above the Bitcoin net asset value, it can actually increase torque. And that's the financial alchemy done correctly, printing the fiat to buy the digital immortal asset, Bitcoin. If you issue convertibles or equity below the NAV, torque drops, shareholder value evaporates. Congratulations, you've invented slow motion rug pulling with legal disclosures. Debt leverage works until it doesn't. Fixed rate bonds can magnify torque beautifully if Bitcoin goes up. If it stagnates, you're left with a balance sheet that smells like expired derivatives. The interest clock never stops ticking even though Bitcoin does. Silence is suspicious as well. In 2025, if a company doesn't disclose its torque, they're either hiding something or they haven't done the math. Both are disqualifying. This is the new baseline. If you're managing a Bitcoin treasury company and you're not tracking or publishing your torque, you are committing capital malpractice. So what's the takeaway? Bitcoin Torque doesn't just measure the past, it shapes future credibility, funding access, and shareholder trust. Let's close with the how and the why. I gave you the formula, but it's powerful. Let's go over it again for good measure. Step 1, add up every dollar spent to acquire the Bitcoin position. That includes equity, bond, face value, the mining fees, the mining expenses, cash from operations. Everything's still embedded in the Bitcoin stack. Step 3, divide the value by the stack of the capital deployed. The result is the Bitcoin Torque. Remember, 2.0, that means that your company doubled your hard money firepower. 0.8, less than 1, that means they took your capital, lit it on fire, and laughed at you. Bitcoin Torque is the rev counter on the corporate Bitcoin engine. It tells you who to fund, who to short, and who to fire. If you ignore Torque, you're buying a Lambo off Craigslist with no oil pressure gauge. If you track it, you're playing a higher game, one where capital is not measured just by volume, but by integrity. And in the age of Bitcoin treasuries, Torque is the integrity index.